And I believe that a combination of quantitative easing, which, as you know, I call counterfeiting, debt and deficits, and negative real interest rates will, over the next 5 years, cause demand for precious metals and precious metals assets to at least return to mean. If they return to mean, it means that demand will triple. All investors want one-size-fits-all answers, and there aren't any. It depends on the investor. Traditionally, gold bullion it's been a form of insurance, Shay. You have preserved your purchasing power in circumstances where the purchasing power in other savings and investment classes gets degraded. So you would buy gold if you believed that the purchasing power of the Australian dollar was going to decline and the value of your savings products, your super, your bank deposits, your bonds was going to decrease. Silver has traditionally been something different. Silver has been more of an investment or a speculation than an insurance product. And if you observe the last two precious metals bull markets that I've lived through, 1970 to 1981, 2000 to 2011, what you will note, among other things, is that those bull markets are led by gold because the fear buyers first. But leadership changes in the middle of those bull markets when the momentum established by gold puts the value of the narrative firmly in the generalist mind. Then silver starts to move. It moves both because its lower unit value allows poorer participants, as an example, the Indian peasantry, poor people in China, to participate where they couldn't afford to buy a meaningful amount of gold. They can't afford to buy a meaningful amount of silver. But it also happens because silver is traditionally more volatile. And people who are buying for one of the two primary investment motivations, the two are, of course, greed and fear. People who are buying from a greed point of view love the upside volatility in the silver market that occurs in the second half of precious metals bull markets. So the answer really depends on who you are. And I must admit, I'm of mixed minds. I believe that the set of circumstances that we see in front of us in the world today should cause anybody who is competent in arithmetic to be concerned about the purchasing power of their savings denominated in fiat currencies, be it the Australian dollar or the US dollar. So I'm attracted to gold. I'm attracted to gold stocks because, ironically, nobody likes them. And I always feel comfortable when I'm alone. But I like them too because in the way that I value them, which is the net present value of future cash flows at today's commodity prices. That is to say, net present value relative to enterprise value, the market capitalization plus debt minus cash. These companies at current commodity prices, their cash flows are the cheapest that they've been in my career. So I think that the commodity is going to go up, and I think the commodity prices, producers are cheap. This is a wonderful circumstance for me. I find myself actually in the position where I own a reasonable amount of gold, a reasonable amount of gold stocks, that I'm hoping the price goes lower because I'd like to buy more. And if there's an asset that you want, you'd like to see it cheaper as opposed to more expensive. That gets me an awful lot of hate in the comments on shows like yours. But I've always felt that the idea that something that I wanted to buy more of was becoming cheaper was a good thing. I have the courage of my convictions. Moving on to silver, Shay, I'm at the point in my career where I don't actually need to speculate, but I can't help myself. What I have seen is that the most volatile asset class in the natural resources space, with the possible exception of junior uraniums, but the most consistently volatile are silver equities, because there isn't enough market capitalization in the legitimate silver equity space to handle the capital that comes into them during precious metals bull markets. I've had numerous experiences with this in my career. Silver Standard from 72 cents to $45. Pan American, 50 cents to $40. Going back before I was cognizant of it in my first bull market, Coeur d'Alene from 10 cents to $65. The upside that you see in the silver equities when the silver market catches on fire is really, truly odd. So despite the fact that I don't need to speculate, given that this may be the last precious metal super cycle of my career, I just can't not participate in the silver equities. And the fact that they're dead, the fact that not only do they bore people, but that people hate them, is particularly attractive. You may remember earlier in the year, the so-called silver squeeze.
Yes.
And I must say, I was surprised by the strength of it. I was surprised that we didn't just run out of retail product, at ABC or places like that. For a while, all those young folks on Twitter actually bought so much silver that even Sprott had trouble getting institutional quantities of silver. We actually did have a legitimate, albeit short-term, silver squeeze. But the real squeeze, Shay, comes very differently. It comes from reversion to mean. It comes from arithmetic, not narrative. In the U.S., I don't know the Australian numbers, but in the U.S., precious metals and precious metals equities comprise 0.5% of total savings and investment assets in the country. The 3-decade mean is 1.5%. And I believe that a combination of quantitative easing, which, as you know, I call counterfeiting, debt and deficits, and negative real interest rates will, over the next 5 years, cause demand for precious metals and precious metals assets to at least return to mean. If they return to mean, it means that demand will triple. It means that the silver squeeze will not come from a young wage earner on his or her cell phone, but rather will come from the AMP. It'll come from Temasek. It'll come from the Harvard University Endowment. If we have reversion to mean, it means that the market share of precious metals and precious metals equities will triple. I actually think that they will do more than revert to mean, but I don't need for them to do more than return to mean. If they merely return to mean, you will see what the real gold squeeze looks like. You'll see what the real silver squeeze looks like, and you'll see, I think, not merely a meaningful but a surprising response in the equities. Is this going to happen over a period of time that will keep your most rabid listeners happy? Probably not. There are many people who adopt the narrative and they want it to take place over a long weekend. And that isn't the way markets work. But, Shay, in the past, you and I have talked a lot about the Barron's Gold Mining Index. When people look at that chart and they look at the anatomy of prior bull markets, what they see is that although the market doesn't give you what you would like to expect when you want to expect it, it is very common over the course of a precious metals bull market to see the index go up 700 or 800%. It is not uncommon to see it go up 100% in a 12-month time frame. The point of that is that although it can bore you in the 2 or 3 years that it isn't moving or is moving down or is in malaise, from a time value of money standpoint, if you're in place for the market when the market moves, the rent it pays you overcomes almost any discount that you might want to charge yourself waiting for it to wait.
I just want to draw on something you said in there. You called this the last precious metals super cycle of your career. Tell me, what identifying factors do you use to define a precious metals super cycle?
I think that we're in a unique circumstance right now. I think that we're coming out of a 40-year cycle that featured rising bond prices and lower interest rates. And I don't think that you can take interest rates meaningfully below zero. So I believe that if we are not at the end of the bond cycle, we are much closer to the end of the bond cycle than to the beginning. And I think that ultimately bonds and gold move countercyclically. Bonds are a good time investment when they're cutting the interest rate. They're raising the value of existing cash flow streams. And if the expectation of the future is benign interest rates and benign economic conditions, nobody's afraid of anything, so nobody buys gold. In a circumstance now where the arithmetic around debt instruments is so bad, yet the prices of debt are still so strong, I think we're coming in for a sea change. Think about yourself, Shay, as the holder of a U.S. 10-year treasury. I know you wouldn't be, but put yourself in that shoe anyway. You loan the U.S. government, which is an increasingly bad credit because of debt and deficits, money for 10 years. And they promise to pay, which they do, absolutely, pay you 1.5%. So far, so good. But they pay you in a currency which they, not some cranky old libertarian, they say is depreciating in value by 6.5% a year. That means that the U.S. government absolutely positively guarantees that they're going to cost you 5% a year in purchasing power compounded. This is the first promise in my lifetime they're likely to keep, other than their attempt to send me to Vietnam, neither of which I had much interest in. So I believe that over the next couple of years, the lessons that we've learned over the last 40 years, which is to say that life is benign, government is good, the Fed is your friend, there is a Fed put, that there's a fat guy in red that comes down your chimney this time of year. All these things, I think, are going to begin to fade in prominence against the arithmetic of getting paid 1.5% in a currency that's depreciating by 6.5% a year. The consequence of that doesn't need to be a replay of the 1970s, which saw gold go from $35 an ounce to $850 an ounce, and saw the interest rate go from, 4.5% to 15.5%. It doesn't need to be that dramatic. It is estimated, by the way, then that the market share of precious metals and precious metals related securities in the United States was between 8 and 9% rather than 1/2%. All I'm suggesting is that the combination of the end of the benign bond era from 1982 to 2022 and quantitative easing and debt and deficit and negative real interest rates will cause the market share of precious metals and precious metals related securities to revert to mean. And if that happens, demand triples and supply can't.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3,000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really, really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.